please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
30 minutes, but first let's talk about the top story today. Talks of the United States and its allies considering airstrikes against Syria have sent crude prices to a 4-year high. So Brent crude is trading above that $71 per barrel mark. There you go, 71.2. And if you look at the NYMEX has recovered a little bit at the $65.8 per barrel mark. Expectations of a disruption in supply were heightened by the pan-European air traffic control warning that air-to-ground and cruise missiles could be used within the next 72 hours. Now, the threat basically follows a suspected poison gas attack in Syria last weekend. But let's get the big voice on this very subject. We won't let another glut resurface in the oil market. A strong promise coming in from the oil minister of Saudi Arabia, the world's largest oil producer, speaking to the media on the sidelines of the International Energy Forum, a gathering of oil producers and consumers in New Delhi. This is exactly what his rationale was.
When oil approached $150 in 2007, Saudi Arabia was extremely concerned at that time, and we called for a major conference in Jeddah, Saudi Arabia, to try to cool the markets down and arrest that escalation. We will not sit by and let another glut resurface.
India being facing a lot of crude oil imports, so we see one risk is crude oil price. We cannot really predict the crude oil price for the future. So if the price level goes, say, up to, say, beyond $70 per barrel, so that may start to affect the inflation in India.
And of course, that impact was seen back home as well, with oil marketing companies cracking in trade today after reports emerged that the government has asked them to absorb up to a 1 rupee per litre price hike in petrol and diesel. So, for instance, HPCL and BPCL ended over 7% lower, while IOC finished with losses of about 6.5%, as you can see on your screens. The government's rationale for the move is a steep rise in global crude oil prices. Sources, in fact, tell CNBC TV18 that a cut in excise duty to lower prices has been rolled out for now by the government. Now, as a result of this move, OMCs will see an erosion of margins by about 1 rupee from the current 3.3 to 3.4 rupees per litre. We in fact spoke to the HPCL chairman M.K. Surana. He said that they haven't seen that significant an impact yet. Let's listen into what he had to say. And interestingly, he has given an outlook as well.
Sir, there are reports that OMCs have been asked by the government to absorb 1 rupee per litre on both petrol and diesel.
We don't have any such input. I've seen some media reports coming up. And there were a lot of people who were asking. We don't have any input, at least to that extent. Second thing is the price not changing cannot be directly attributed to this. The pricing is a function of 15 days rolling price.
There have been kind of discussions between the government and these companies that, what could be, without making any big changes in terms of policy. Petrol, diesel are decontrolled commodities, as you know, so the government can't really issue any instructions as such. But government being the biggest stakeholder in these companies, they can always have conversation on these lines.
Okay, sticking to this sector, another big story that has emerged today. Saudi Aramco today signed a memorandum of understanding, or an MOU, for 50% stake in Ratnagiri's refinery project. Now, the refinery cum petrochemical project is worth about $44 billion and has a capacity of 60 million tons. Speaking exclusively to CNBC TV18 earlier, Saudi Aramco CEO Amin Nasser said that they are looking to complete the project before 2025. Amin, in fact, added that they are actively looking for opportunities in India within the petrochemical and refining space. So, yes, acquisitions could be around the corner.
Well, for the MOU signed today, we'll do the basic, the feasibility and then basic engineering, and then you get into front-end engineering. So hopefully we will do our best with our partner to accelerate the process. What was mentioned that we are hoping for a completion of the whole project before 2025. We are looking, as I said, for further growth opportunities within the Indian market. As you highlighted, there's a growth opportunities, especially in the petrochemical sector as well. His Excellency the Minister highlighted that there is also interest from other companies like SABIC in the Indian markets. For Saudi Aramco, It has to be integrated between refining and petrochemicals. And this is where hopefully it will not be the only agreement that is signed. There are going to be other agreements hopefully in the future.
Okay, let's put this into perspective. If it goes through, how will the absorption of a 1 rupee per litre hike on fuel prices impact oil marketing companies? We were talking about this just before the Saudi Aramco story. Let's bring in Prashant Nair, who has done some number crunching. Prashant, take us through your analysis. What's the broad impact that we can expect?
So we are basically talking about apparently the government having told oil companies rather, was the exact terminology. So we don't know if it is only downstream or it includes upstream as well, but having told oil companies to absorb a 1 rupee increase in the retail sale price of petrol and diesel. So this is essentially what sparked the entire sell-off. Remember, the government has already ruled out, to us on various forums, in the recent past, ruled out a cut in excise duty. So that's the basic news. There has been no statement really coming out from the government either confirming this or denying this. And this has been standard practice in earlier episodes as well. I'll get to that in just a bit. Now, absorbing 1 rupee, what will that mean? If they were to absorb a rupee, what would it mean? Oil marketing companies right now are making fat marketing margins. So the gross refining margin over the last couple of years was about 2.5 rupees or so. They are currently making around 3.5 rupees a litre on both petrol and diesel. So this is higher than what you'd say sort of call normal kind of marketing margins. 1 rupee absorption would essentially straight away eat into that gross marketing margin and take it back to about 2.5 odd rupees a litre, which is what the marketing margin was over the last couple of years. So 1 rupee prima facie doesn't seem like it's such a huge financial impact. The extra margin which these companies were making will be shaved off. Will upstream companies share the burden? We don't know that. But if the answer to that question is yes, it will mean that the burden on downstream companies will be further reduced. What did we see in 2017? I'm going back to the last episode when this kind of happened, and this was around the time of the Gujarat state elections. We saw going into the elections for many weeks, there were no price increases even as global oil prices were going higher. There was no formal communication from the government saying that we've asked oil marketing companies not to increase, but we didn't see any hikes, and as a result, marketing margins were compressed. After the state election of Gujarat, prices were marked up pretty rapidly by oil marketing companies, and that's when we finally ended up at this 3.5 rupee a litre gross marketing margin. I think it's instructive to look at what has happened in previous episodes, because it may give us a clue as to what might happen now. What is the real worry? The real worry is that this year, 2018, is lined up with not just one state election, but a couple of big and crucial state elections leading up all the way to the general elections in 2019. So will we see a repeat of this stop-start kind of action by oil marketing companies going into a crucial election, no price increases? After the state election, they're free to increase prices and sort of repeat. That cycle sort of continues. I think it would give a clear signal, and I think the market didn't take it very well, because there is worry that even if these price increases, the cap on these prices are temporary, which is up till a state election gets over, this will impact sentiment quite adversely. Are we going back to the era when prices were regulated? Are we junking the entire deregulation sort of story? Because that is going to sour sentiment quite a bit. Back to you.
Okay, Prashant, thanks for that very detailed analysis. Let's quickly take a look at how Indian equity markets fared today. After a weak start, the Wall Street did manage to close in the green for the 5th consecutive day. So the Nifty held on to the 10,400 mark after breaking that level in early hours of trade. Sensex closed above the 33,900 mark. Mid-caps recovered 132 points from lows to close flat to roughly positive. And the Bank Nifty recovered but still closed below about 50-day moving average, dragged by SBI and ICICI Bank. From equities to bonds, India's bond yield surged in trade today, fueled by inflation concerns. However, yields started softening marginally on reports that the government is mulling sovereign bond issue in the overseas markets in FY19. So if the government goes ahead with this move, it will be a first for the country. Lata Venkatesh is here to put this into perspective. Hi Lata, what can you tell us about the plan that's believed to be under consideration at this point?
Well, this plan does come in every time it looks like there is going to be a major oil price hike, or for some other reason the government will be unable to meet its fiscal deficit. And so it's not surprising that the sovereign bond is being considered again. How is it different from the government borrowing now? Right now, the Indian government borrows in rupees by raising what you call Government of India Securities, or G-SECs. Foreigners can buy these G-SECs, but they are taking a rupee exposure. There is no dollar involved. There's no foreign exchange impact involved. And even here, the Government of India is extremely careful to ensure that only 5% of the total outstanding bonds are allowed for foreigners. Recently, earlier this week, that limit got raised to 5.5% for the current year and 6% by next year. But ever since probably the IMF called back the loan and India was forced to pawn its gold to repay, Indian governments have been extremely sensitive to borrowing from foreign sources, and that is why a sovereign bond issue was never considered. A sovereign bond issue is one where you sell a Government of India bond denominated in dollars. So just as you may have a Tata bond or a Reliance bond or a NTPC bond, you have a Government of India bond out there. The reason for the resistance is that in the event of such a sovereign bond, if there is a downgrade of the country's rating, then immediately the sovereign bond is impacted, and by default all other instruments, corporate instruments, are also traded below the sovereign, and that kind of impacts the country's borrowing ability rather severely, impacts its macros as well. It's also a window the government does not want to open, or rather the Reserve Bank usually resists. The last time this idea came was obviously during taper tantrum, when there was a problem with both the fiscal deficit and the current account deficit and a run on the rupee. The idea was that you raise these dollars and shore up the FX reserves. But Governor Subbarao at that time clearly said that it's something the Reserve Bank would not like. And if at all we go for it, it should be at a time when we are stronger. Of course, India is much stronger now, but going for a bond issue like this definitely weakens, or at least opens the flanks of the country to be attacked at a time of crisis. So chances are this is on the table, but it might find severe resistance from the Reserve Bank and may not be resorted to at all.
Okay, we'll have to wait and watch out to see if this does go through. Lata, thanks for joining in with that. We will take a short commercial break, but up next, after Indigo and Jet, another potential contender rules out any bidding plans for Air India. Who is that and why? We will tell you after this break. Welcome back. You're still with After the Bell on CNBC TV18. Now, we don't have any intention to buy or acquire any airline. That's Emirates' response to CNBC TV18's query on whether they plan to acquire debt-laden Air India. Remember, the last date for submission of expression of interest for Air India is the 14th of May. Emirates further added that they are currently not looking to buy or acquire any airline, and that they will partner with other airlines only if it makes commercial sense for them. As of now, Jet Airways, Indigo and SpiceJet have ruled out bidding for Air India, so no takers for the national carrier just yet. But here's another big story from the deal space. Global e-commerce major Amazon has stepped up its efforts to acquire a significant stake in India's e-commerce giant Flipkart. A report by Mint suggests that Amazon may submit a rival offer to buy Flipkart. Remember, Flipkart is also in advanced talks with Walmart for stake sale, and now a Factor Daily report says that Amazon may offer a breakup fee of up to $2 billion for deal talks with the Indian e-commerce company. For more on these reports, I am joined by Mint's Shrutika Verma and Factor Daily's Sunny Sen. Shrutika, coming to you first, what have you picked up from your sources? Are we actually expecting Amazon to pip Walmart and emerge a buyer for Flipkart?
Hi, that is correct. We have been hearing about, Amazon's rival bid for Flipkart. That clearly shows the sort of interest in India's e-commerce market. So, as you see, Amazon already fights with Walmart in the U.S. So, this clearly shows that, this is going to be a large battle once if Amazon bids for Flipkart and Walmart is also in the game. This is just going to be a large battle going forward.
Oh, absolutely. In fact, let's bring Sunny into the conversation. Sunny, you have reported in Factor Daily that Amazon is planning to offer a breakup fee of up to $2 billion for Flipkart deal. How exactly will that work? You know, we haven't seen a breakup fee as such come out, at least in such large deals. So how exactly will that work? And do we have details in terms of numbers on what the offer will be and how the breakup would work?
Right. So essentially, in most of the cases when a deal happens, the buyer usually doesn't pay the breakup fee. But in this case, the desperation from Amazon's side to win in India after failing in China miserably, where it has got less than 1% market share, it becomes very evident that Amazon wants to plug in all gaps, go full hog to be an important and a major player in the Indian e-commerce space. That is the reason why the breakup fee. The breakup fee that Factor really learned from three of its sources yesterday was anything between $1 to $2 billion, but most likely it will be which will be close to 1.5, 1.6 billion is what it's largely is estimated to be. So in this case, if by any chance Amazon backtracks or moves out of the deal, Flipkart gets that kind of money, which is very important at this time for Flipkart, which is still battling a bloody battle with Amazon and some of the other e-commerce companies.
Yes, Sunny and Shrutika, thanks very much for joining in and breaking up those very critical developments. That's a big deal that we are expecting to unfold over the next few months. We will take a very short break on that note, but coming up on the other side, government meets key stakeholders to discuss FDI in tobacco sector. Details when we return. Let's get you the latest from the FDI in tobacco sector space. The Department of Industrial Promotion and Policy and Promotion met stakeholders from the industry to discuss FDI in the sector. Remember, Centre had floated a cabinet note in 2016 to completely ban FDI in tobacco sector. Ritu Bhoyan has been tracking the story very closely and he's here with the details. Ritu, what is the mood like among tobacco companies and the farm organizations, and any clarity on numbers and confirmations that we can expect?
Well, in the 2016, there was a proposal to completely ban FDI in the sector because FDI was coming in through several other routes which are permitted. For example, technology-related issues or branding, contracts, etc. Now, there was a lot of resistance to that proposal in 2016, and the proposal had gone into the cold storage. Today, there was a meeting on that particular issue where 24 stakeholders were consulted by DIPP, which included Indian companies like ITC, you had Philips Morris International, you had Godfrey Philips India, and after speaking to many of these participants, it was clear that there are sharp differences on this issue. While foreign companies would want no restrictions to be imposed on FDI in tobacco sector, you also have Indian companies like ITC who would want restrictions. At the same time, you have farmer organizations from one part of the country wanting restrictions on FDI, while other farmers, especially from Andhra, wanting FDI in the sector. I spoke to KK Modi of Modi Enterprises, who was present in the meeting, to ask him how much FDI has come in and if banning FDI is a solution to the issue. And this is what he had to say.
Level playing field should remain, and there is no need in change of policy. Most of the large companies of the world are already here. So if you ban few more, that is not going to change the ground reality. But on the other hand, it will perpetuate monopoly. Not much FDI has come because no new licenses for manufacture are being given.
Okay, let's get the big global headline of the day. Facebook founder and CEO Mark Zuckerberg came face-to-face with the US Congress last night for his testimony in the Cambridge Analytica scandal. Remember, Facebook has been embroiled in controversies ever since reports of a research firm, Cambridge Analytica, gaining improper access to personal information of as many as 87 million Facebook users started doing the rounds. Zuckerberg apologized for his company's shortcomings. He also took questions from the Senate Commerce and Judiciary Committees during the marathon 5-year-long hearing. Well, we will get you a little bit more on what he had to say in that testimony, but we will have to wrap up this edition of After the Bell. Many thanks for watching the show. Stay tuned though. Markets Today Talkback will take all the market action forward on the other side of this short break. Don't go anywhere.